Hello everyone, this is Dr.R.Brinda, Assistant Professor of Commerce, Sri Shada College for Women Autonomous Salem. In this video, we are going to discuss about the topic Amalgamation, Absorption and External Reconstruction in the subject Corporate Accounting. From this video, you can able to know the meaning of amalgamation, absorption and external reconstruction, differences between these terms and the meaning of purchase consideration and methods of purchase consideration. Let us explain one by one in detail. First one is amalgamation. Amalgamation involves two or more companies merging to create a new company. The merging companies goes into liquidation and a new company is formed to take over the businesses. A new legal entity is created, replacing the original companies. The purchase price is determined by the companies in a mutually agreed ratio. Real-time examples of amalgamation are Maruti Motors and Suzuki merging to form Maruti Suzuki Limited. Another example is Hero and Honda amalgamated and form a new company, Hero Honda. The aim of the amalgamation is to remove the competition among the entities. Next one is absorption. Absorption means takeover. Here, one company purchasing another company where the acquired company ceases to exist legally. One company purchases another company with the intention of taking the assets and liabilities of the acquired company. It is not like an amalgamation. Here, one company take over the other company. It is not merging together. It just take over the other company. Examples of absorption are Tata Tea's acquisition of Tetley Tea, resulting in the Tetley, the brand becoming part of the Tata Tea. Another example is Kotak Mahindra Bank absorbed ING Vysya Bank. Here, the assets and liabilities of the absorbed company are transferred to the acquiring company. The features of absorption are here more than one company is liquidated. No new company is formed under absorption. Because in case of amalgamation, the new company is formed by merging the two companies. But here, one company take over the another company and the new company is formed. The business should be of similar nature. Usually, the large concern, that is the big sectors, take the small sector in order to avoid competitions. Next thing is external reconstruction. External reconstruction is a combination of both amalgamation and absorption. It is regulated by Section 232 of the Companies Act 2013. In the context of business, extraction or external reconstruction refers to the restructuring of a company by transferring its assets and liabilities to a newly formed company. Essentially, the existing company is liquidated and a new entity takes over its operations. Here, external parties like investors, creditors, shareholders, and consultants involved in this external reconstruction process. Usually, external reconstruction is undertaken in companies like those who incurred losses or they are sick due to financial activities. The next one is differences between these terms. In that first thing is amalgamation absorption. Yeah, already we discussed the meaning of amalgamation absorption. With that, we can easily coincide the between these terms. Here, amalgamation is merging of two companies, but absorption is taken over of one company by another company. So here, liquidation is taken place for two or more companies. But in case of absorption, only one company. That is the company which is absorbed only liquidated. Another one is in the case of amalgamation, new company is formed by merging that existing companies. But here in the case of absorption, no need to create a new company because already existing company take over the another company. The next differences is between external reconstruction and absorption. Here absorption New company is not formed, but in the case of external reconstruction, a new company is formed. It undertakes the sick companies and framed a new company. In absorption, there is a combination of businesses, that is, two or more entities joined together to create a new firm. But in external reconstruction, there is no combination of business. The main advantage of observation is it will avoid the large scale operation, that it is the best way to enjoy the economies of scale of production. The external reconstruction is structured to rehabilitate the sick units. The last one is in absorption, it involves two or more companies, but in external reconstruction, it involves only one company. The next one is differences between external reconstruction and amalgamation. So, amalgamation involves two or more companies merging to create a new company. But in external reconstruction, it is regulated to restructure the affairs by transfer assets and liabilities. So, in external reconstruction, only one company goes into liquidation. That is the sick units or the units which are taken by the large sector. In amalgamation, both the companies, that is which companies are merged, all the companies are goes into liquidation and form a new company. In amalgamation, there is no combination of companies, but in amalgamation, there is a combination of companies. So, the differences between amalgamation, absorption, and external reconstruction is here in amalgamation, two companies merged and form a new company. The two companies called selling company and the new company formed is called the purchasing company. For example, Maruti and Suzuki. So both are selling companies. And the new company, Maruti Suzuki, is called purchasing company. In absorption, we discussed one example, Tata Tea and Tetley Tea. Here, Tata Tea is a purchasing company and Tetley Tea is a selling company. So here, only one purchasing company and only one selling company. But in amalgamation, both the companies are called selling company and the new company is called purchasing company. In external reconstruction, one company restructured its assets and liabilities with its current or existing shareholders to create a new company in order to rehabilitate that, in order to uh, encounter their problems, financial risk, and to strengthen their activities. It restructured their financial position. This is called external reconstruction. Next thing is purchase consideration. Consideration means something in return. Yeah, in this business world, everything is done to get something. If one person sell a good, in return he will get a money, that is profit. If a buyer buys the goods, in return he will get some possession or title of the good. So each and every activity coincide with some favor. Here, in case of amalgamation, absorption, or external reconstruction, the companies combine together, or companies or taken over by some other company, or it restructured the position, whatever it may be. The main purpose is to get something in return. That is called purchase consideration. So, for purchasing the business, it should pay something. Here, the purchase consideration is set to the total value or amount paid by the acquiring company, that is the transfer it to the acquired company, that is the transferring company, in exchange for taking over the transfers company's businesses. So it is defined as the price paid by the purchasing company to acquire the ownership or business of the selling company. It is crucial in mergers and acquisition as it impacts the financial statements, tax liabilities, and shareholders' interests. Because in the matter of amalgamation or absorption, the shareholders play a very vital role. They must acknowledge or vote for the particular activity. Then only it will be comes to the true one. So this purchase consideration is the thing which will impact the decision of the shareholders. This purchase consideration is payable in the form of cash, shares, or other assets as agreed upon by both the companies, that is, the transferring company and the transferor company. In short, it is the amount agreed by the purchasing company and selling company for the act of amalgamation, absorption, or external reconstruction. This purchase consideration can be calculated by following various methods. It is also called procedure for calculating purchase consideration. The methods are lump sum method, net payment method, net asset method, and the last one is intrinsic value method. First one, lump sum method. In lump sum method, a fixed amount is agreed upon between the buyer and seller. That is, when transferring company agreed to pay transferor company a fixed sum of money, that is the amount in bulk or lump sum. For example, XY Limited agrees to pay ABC Limited 25 lakhs. Then this method of purchase consideration is called lump sum method. Here, there is no need for value of assets or any purchase calculations. Simply it stated the amount 10 lakhs, 20 lakhs, 25 lakhs. So this amount is called lump sum amount. It is very simple and easiest method to settle the purchase consideration. Next one is net payment method. Here, the transferring company makes individual payments to the equity shareholders and preference shareholders either by way of cash, shares, or in the form of debentures or any other assets. Here, the net payment is calculated by the value, that is, for every two shares, one share in this company and 5 rupees by cash, like that it is formulated. So it involves little calculations. It is not like lump sum method. It is a little bit calculated and purchase consideration will be settled. So here the value of shares to be calculated and the value of cash to be calculated, value of debentures to be calculated, or any other form of assets to be calculated, and the total purchase consideration will be settled to the shareholders. Next thing is net asset method. In this method, the purchase consideration is calculated based on the value of assets less the outside liability, excluding share capital and reserves taken over by the transferring company. As per AS 14, the value of assets and liabilities shall be calculated at the value as agreed between the two parties, that is, the transferee and the transferor. If there is no value agreed, then assets and liabilities taken over at the book value. So the formula is given for calculating purchase consideration under net asset method is net assets equal to total assets minus total liabilities. Here total assets include all assets and total liabilities include all assets except share capital and reserves. The next thing is intrinsic value method. This method determines purchase consideration by valuing the shares of the transferor company, that is the vendor company, based on the intrinsic worth. That is, this method is also like net asset method. It considers the asset value of the company. This method focuses on the net asset value per share of the transfer company to calculate the fair exchange ratio for the shares offered by the purchasing company. It is calculated by dividing the company's net assets available to equity shareholders by the number of equity shares. It is a comprehensive approach that focuses on the fundamental value of the target company. Usually, this is based on the intrinsic value, that is the ratio. Exchange of ratio is calculated by using the net assets value. Thus, these are the four methods in which purchase consideration is calculated in the case of amalgamation, absorption, and external reconstruction. So, with the help of this video, you can able to know the meaning of these three terms: amalgamation, absorption, external reconstruction, and the difference between these terms. And the main thing is to calculate purchase consideration under lump sum method, net payment method, net asset method, or intrinsic value method. Thanks for your patient listening. Thank you.